Here's how much silver would you need to be in the top 1% of stackers. What if I told you that the amount of silver required to place you in the top 1% of all stackers in the world is far less than you think? Not thousands of ounces, not a vault full of bars. We're talking about a number that most working people could realistically reach if they started today. But here's the twist. The window to get there may be closing faster than anyone is prepared for. Stay with me, because by the end of this video, you're going to know exactly where you stand, what the top 1% actually looks like, and why reaching that threshold right now, at this specific moment in history, could be one of the most asymmetric financial decisions of your lifetime. Most people who watch videos about silver are already ahead of 99% of the population just by paying attention. Think about that. The average person has zero silver. No coins, no bars, no exposure whatsoever. They're sitting in cash that loses purchasing power every single year, in savings accounts that pay interest rates that don't even keep pace with real inflation, in a system that was designed, not by accident, to keep wealth concentrated at the top. So when we talk about the top 1% of silver stackers, we're not talking about hedge fund managers or central banks. We're talking about a surprisingly accessible threshold. But here's what most investors completely miss. It's not just about the number of ounces you own today. It's about understanding why that number matters at this exact moment in the macroeconomic cycle, and what happens to the people who cross that threshold before the next major move in silver. Most people will figure this out too late. You won't, because you're still here. Section 1. The global silver ownership picture. Let's start with the foundation, the raw, uncomfortable data. There are approximately 8 billion people on this planet. Of those 8 billion, credible estimates suggest that fewer than 1% hold any meaningful physical silver position whatsoever. When you break down global household wealth surveys, precious metals ownership data from the World Gold Council and related institutions, and retail sales figures from the US Mint, the Royal Canadian Mint, and the Perth Mint, a picture emerges that is both shocking and revealing. The vast majority of humanity has no silver. None. In developed nations like the United States, survey data consistently shows that fewer than 5% of the adult population holds any precious metals at all, and within that group, the average position is surprisingly small. So what does the top 1% actually look like? Here's where it gets interesting. Conservative analysis of retail stacker communities, forum data, vault storage estimates, and mint sales figures suggests that owning somewhere between 500 and 1,000 ounces of physical silver likely places you in the top 1% of all private silver holders globally. Let that land for a moment. 500 ounces. At current prices, that's an investment accessible to a serious, disciplined saver over a period of years, not decades. But the number alone isn't the point. The point is why crossing that threshold right now, in this particular macro environment, carries a weight that is completely different from any other period in recent financial history. Section 2. The macro context. Why right now is different. To understand what's happening with silver, you need to understand what's happening to the broader financial architecture of the world. Because these are not separate stories. They are the same story, told from different angles. We are living through the largest debt expansion in human history. That is not hyperbole, that is arithmetic. Global debt has now surpassed $313 trillion. The United States alone carries a national debt approaching $36 trillion, a number that was unimaginable just 20 years ago. And critically, the cost of servicing that debt is now consuming a larger and larger share of federal revenue with every passing quarter. Here's the mechanism that matters for silver owners. When governments carry debt loads this large, they face a narrow set of choices. They can raise taxes, politically toxic. They can cut spending, nearly impossible in an election-dependent system. Or they can allow inflation to quietly erode the real value of that debt over time. History tells us which path governments almost always choose. They inflate. And when fiat currency is deliberately or structurally debased, when the purchasing power of paper money is eroded, hard assets don't just hold their value, they reprice. Sometimes violently, sometimes suddenly, almost always in ways that reward the prepared and punish the unprepared. Now add a second layer to this. The Federal Reserve is caught in a trap it has never faced before at this scale. Rates are high enough to slow the economy and pressure the banking system, but cutting rates aggressively risks reigniting inflation in an environment where the dollar's global dominance has already been quietly challenged. BRICS nations are deepening bilateral trade agreements denominated outside the dollar. China and Russia have been accumulating gold at a pace that signals long-term strategic intent. Saudi Arabia is quietly reopening conversations about pricing oil in alternative currencies. De-dollarization is not a conspiracy theory. It is a slow-moving, structural shift being documented in real time by institutions including the IMF, the Bank for International Settlements, and major sovereign wealth funds. And silver sits at the intersection of every single one of these forces. Section 3. The dual nature of silver. Why it's different from gold. Here's what separates silver from every other asset in this macro environment. Silver is not just money. It is not just a store of value. Silver is an industrial metal, a critical material, a resource that sits at the heart of the technologies the world has decided it cannot live without. Let's talk specifics. The global solar energy build-out requires silver. Photovoltaic cells, the panels that convert sunlight into electricity, use silver paste as a conductor. There is no commercially viable substitute at scale. The International Energy Agency has projected that solar capacity needs to triple by 2030 to meet clean energy targets. Every gigawatt of solar installed requires millions of ounces of silver. Electric vehicles require silver. Advanced electronics require silver. The AI infrastructure boom, the data centers, the power systems, the advanced semiconductors requires silver. The world is not using less silver as it modernizes. It is using more, structurally, irreversibly, at a pace that is accelerating. Now look at the supply side. Silver mine production has been essentially flat for years. New primary silver mines are expensive, time-consuming, and increasingly difficult to permit. The majority of silver produced globally is a byproduct of mining other metals, copper, zinc, lead, which means silver supply doesn't respond cleanly to silver price signals. The Silver Institute, one of the most authoritative bodies tracking this market, has documented a structural supply deficit for multiple consecutive years. Demand is outpacing newly mined supply. That gap is being filled by above-ground inventories and recycling, but both of those sources have limits. This is not a narrative constructed to sell silver. This is the physical reality of a market that is tightening in real time. And here's the question you should be sitting with right now. If industrial demand alone is creating a structural deficit, before we even factor in investment demand or monetary demand, what happens to price when institutional investors and sovereign funds decide to treat silver the way they've been treating gold? Section 4. The gold-silver ratio and the historical argument. Let's talk about one of the most powerful and most misunderstood indicators in the precious metals world. The gold-to-silver ratio. Right now, that ratio sits at historically elevated levels, somewhere in the range of 80 to 90 ounces of silver required to purchase 1 ounce of gold, depending on when you're watching this video. The historical mean for this ratio, over centuries of recorded data, sits somewhere between 15 and 30. That is a staggering divergence. Now, does the ratio revert to its historical mean? Not automatically, not on a schedule. Markets don't work on the logic of fairness. But here is what history does consistently show. During periods of monetary stress, during inflationary episodes, during dollar weakness cycles, during geopolitical realignments, silver has historically closed the gap with gold. Not gradually, rapidly. In 1979 and 1980, as the United States faced runaway inflation and a dollar crisis, the gold-silver ratio collapsed from the 80s down to 17. Silver moved from under $2 to nearly $50 in just over a year. In 2011, as the aftermath of the global financial crisis pushed investors toward hard assets, silver again surged, moving from below $20 to nearly $50 in a compressed time frame. These are not cherry-picked anomalies. They are the repeated behavior of a suppressed asset repricing to reality during periods of financial stress. And the macro conditions that historically precede those moves, elevated government debt, currency pressure, geopolitical instability, industrial supply constraints, rising institutional interest in hard assets. Check, 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 check. I'm not telling you silver goes to $50 or $100 or any specific number. No honest analyst can give you that certainty. What I am telling you is this: the conditions that have historically preceded silver's most dramatic repricing events are more clearly aligned today than at almost any point in recent memory. Section 5. What the top 1% actually looks like and how to get there. Let's bring this back to the personal level, because macro analysis only matters if it changes what you do. We established earlier that owning somewhere between 500 and 1,000 ounces of physical silver likely places you in the top 1% of all private silver holders globally. But let's be more precise. Let's build a tiered picture. Tier 1, 0 to 50 ounces. This is where most people who have any silver at all currently sit. A few coins, a small bar picked up at a local dealer, meaningful as a starting point, financially significant only at dramatically higher silver prices. Tier 2, 50 to 250 ounces. This is where serious retail stackers congregate. This is someone who has made a deliberate, sustained commitment to accumulating silver over time. At a silver price of $30, this position is worth between $1,500 and $7,500. Meaningful, but not yet transformational. Tier 3, 250 to 500 ounces. This is the upper tier of serious retail accumulation. A position of this size, purchased at current prices, represents a genuine financial commitment and genuine asymmetric upside if silver reprices significantly. This is where the math starts to become compelling. Tier 4, 500 ounces and above. Based on available data and reasonable modeling of global private silver ownership, this likely represents the top 1%. Not 1% of the general population, 1% of all people who own any silver at all, a rarefied group within an already tiny minority. Now here's the insight that most people miss entirely. Because silver is priced, by many analysts' assessments, at a deep discount to its intrinsic industrial and monetary value, reaching these thresholds today costs dramatically less than it may cost in 2 years, 5 years, or 10 years if the macro thesis plays out. The people who will look back on this period with clarity will not be the people who had the most sophisticated analysis. They will be the people who acted while the window was open. Section 6. The COMEX dynamic and paper versus physical. There's one more layer to this that you need to understand, and it's the layer that most mainstream financial commentators refuse to talk about directly. The silver market, as it is currently structured, is not a simple, transparent price discovery mechanism. The price of silver that you see on your screen is set primarily through the COMEX futures market, a derivatives market where the overwhelming majority of contracts are settled in cash, not physical metal. That means the price signal you're receiving is generated by a market where most participants have no intention of ever touching an ounce of actual silver. For years, analysts tracking the ratio of paper silver contracts to physical silver inventory at COMEX warehouses have documented ratios that strain credibility. At various points, the number of ounces represented by outstanding paper contracts has dwarfed the physical silver available for delivery by extraordinary multiples. This creates a structural fragility. And it creates an opportunity, because the moment that gap between paper price and physical reality closes, the moment physical demand overwhelms the paper market's ability to suppress the price signal, the repricing event that follows will be unlike anything most retail investors have ever witnessed. The Shanghai Futures Exchange has been steadily building its own silver trading infrastructure. Asian physical demand, particularly from China and India, has been growing at rates that dwarf Western investment demand. The architecture of price suppression that has kept silver at these levels is not eternal. Nothing in markets is. The question is not whether the gap closes. The question is whether you're positioned before it does. Section 7. The psychological edge, why most people won't act. Here's the uncomfortable truth that sits underneath all of this analysis. Most people who watch this video will not act on what they've heard, not because they lack the information, not because they lack the resources, but because of something far more powerful and far more difficult to overcome: normalcy bias. The human brain is wired to assume that tomorrow will look like today, that the financial system that has existed for our entire lives will continue to function as it always has, that the warnings and the data and the historical precedents are interesting, but probably not urgent, probably not for right now, probably something to deal with later. And later, in financial markets, is almost always too late. The people who accumulated silver in 2009 and 2010, after the global financial crisis had already exposed the fragility of the system, were not geniuses. They were not insiders. They were simply people who took the data seriously, while the majority was still in denial. The people who are accumulating silver right now, quietly, consistently, without fanfare, are doing the same thing. They're not waiting for certainty, because certainty in markets arrives at the peak. When everyone agrees, the opportunity is already gone. Smart money doesn't wait for consensus. Smart money positions before consensus forms. So here's where we land. The top 1% of silver stackers globally likely own somewhere between 500 and 1,000 ounces of physical metal, a threshold that is, by any honest measure, within reach for a disciplined, committed investor operating over a reasonable time horizon. The macro environment surrounding silver, debt monetization, dollar pressure, industrial supply deficits, COMEX structural fragility, de-dollarization trends, and an historically elevated gold-silver ratio has rarely been more aligned. And the number of people who understand all of this and are acting on it remains remarkably small. That is either a warning signal or an opportunity, depending entirely on which side of it you're standing on. Here's the question I want to leave you with. 10 years from now, when the next chapter of this monetary story has been written, which side will you have been on? The side that knew and waited, or the side that knew and acted? The window doesn't stay open forever. It never does. If you found this analysis valuable, the next video covers exactly why the gold-silver ratio has been one of the most reliable macro indicators in precious metals history, and what its current level may be telling us about what comes next. Don't miss it.